Good afternoon, everyone, and welcome to today's panel discussion. I apologize for the slight delay due to the technical error. So thank you so much for investing your time with us on a Thursday afternoon. My name is ST, and I am your host for today's session. As ESG is a hot and popular topic now in the market, our session today will bring you more insights on this subject. Our moderator is Azanne Leng. Azanne is a relationship manager in the strategic business development team of Phillip Capital Malaysia. She is responsible for assisting fund marketing and client services to B2B partners in Malaysia. Prior to this, she worked with Royal Bank of Canada, assisting clients globally. As for our panelists, we are pleased to have Nicholas Stott, Associate of Business Development from Arabesque Asset Management on behalf of BIMB Investment Management Berhad. Nicholas is an associate in the business development team of Arabesque Asset Management. He is based in a Singapore office where he is responsible for assisting with fund marketing with client services in the APAC region. Prior to this, he was based in the Singapore office where he was assisting with client services globally. Nicholas holds a Bachelor of Science in Economics from University College London. Next, we have Ms.Penny Leong, Vice President of Retail Distribution from Allianz Global Investor on behalf of Affin Hwang Asset Management. Ms. Leong joined Allianz Global Investors in February 2018 as part of the retail distribution team in Singapore. She is responsible for handling the relationships and business development with various business partners in Southeast Asia, particularly Malaysia. Before joining Allianz GI, Ms. Leong was the head of distribution in Amandi, Malaysia. She was also the head of IUTA in M Funds Management Berhad, leading the sales team servicing all institutional distributors of the company. She started her career in the financial industry as a relationship manager, financial institutions in CIMB Principal Asset Management. She then moved on to join Hong Leong Bank Berhad as an investment specialist and subsequently to Royal Bank of Scotland, overseeing the team of investment consultant. Ms. Leong has more than 17 years experience in retail sales and marketing and graduated with a Bachelor of Commerce, majoring in Management and Marketing from Curtin University of Technology, Perth. Last but not least, our last panelist is Alex Rowe, Lead Portfolio Manager of Global Sustainable Equity from Nomura Asset Management UK Limited. Alex has been with Nomura Asset Management since 2014 and has led the development and management of the sustainable equity strategy since its inception as a publicly reported paper track record in July 2017. He has been a professional equity investor for 9 years with a particular focus on sustainable investing since early 2016. He holds a Master's of Chemistry with First Class from University of Oxford and is also a CFA charter holder and an alumni of the SID Business School Impact Investing Executive Program. Okay, over to you, our moderator, Azanne.
Hi everyone, good afternoon. So without further ado, let's start with our session today. So the first question is directed towards Penny and Nicholas. ESG has been gaining popularity, which can be observed by the increasing numbers of ESG thematic funds available in the market currently. So we'd just like to get your opinion on this. Why should investors consider ESG investing?
Okay. Good afternoon, everyone. Thank you so much for the opportunity for me to actually share some ideas on ESG. So sustainability, sustainable investing approaches can actually deliver positive outcomes and also active engagement with the company in which we invest offers actually potential benefits. And also, if we compare the performance of the global indices, and against the sustainable index, it is actually quite clear that the performance gap has actually widened over the last 3 years. And it goes to show that growing relevance of sustainable investments. And during drawdowns, it is also proven that sustainable investment are indeed able to reduce overall risk associated with ESG factors and contribute to better financial outcome over the long term. At Allianz GI has been a pioneer, has a pioneering history in sustainable investing itself. And I think our track record and commitment to ESG dates back to 2 decades ago, way before ESG has become a trending topic. So I think our sustainable fund was actually launched in 1999, and I think sustainable investing is in our DNA. So for us, we think that our conviction today is that ESG factors matter in all investment decisions. And reflecting on the diverse needs of our client, we offer a range of sustainable approaches that support clients in managing risks, addressing real-world problems, and generating returns from investment. Now, while accurate information on a company's financial performance is extremely important, it does not provide a complete picture in an economy where an increasing percentage of a company's assets are intangible and are not shown on the balance sheet. Intangible assets include reputation, human capital, intellectual property, customer loyalty, and also brand value. Many of this will fall into the ESG category. So that's why I think it is becoming more and more important over the years.
All right, thank you, Penny. Nicholas, any thoughts on this? Hi, Nicholas, can you hear? Okay, I think Nicholas is currently having some technical difficulties. Maybe we can direct this question to Alex instead. Would you like me to repeat the question?
No, that's okay. Thank you.
All right, no worries.
I think actually, we have a slightly different opinion to Penny. Actually, we really think it's ultimately the performance argument is. It's a bit one-dimensional because ESG in itself is so incredibly diverse and means so many different things to different people. When you talk about ESG funds outperforming or underperforming, you're really comparing quite a heterogeneous set. And there's a number of reasons why ESG funds outperformed last year, and a lot of that was to do with growth bias or quality bias. But I would say actually the most important thing, why you should be thinking about ESG is because it's the right thing to be doing. I think it's a very simple, perhaps crude analogy, but I think you're getting to the stage where simple kind of real world example, almost you're stood, you've got some rubbish and you're stood next to a bin and or a recycling bin. Why would you not, put your plastic bottle in the recycling bin? I think society's changed. I think we all care about our personal impact, and everyone's realizing actually you can have a massive you do have investors and the capital that's given to them by their clients has a massive impact on the world. And through investing in ESG strategies, you can have a more positive impact with your capital. You can give your asset manager a mandate really to pursue trying to have a positive impact on companies. So you really just think the main reason is it's just really the right thing to do. So society has changed, and that's really the most important reason for ESG investing. And the arguments around performance are, I'd say honestly to everyone watching this panel, they're quite light, to be honest, when you actually dig down deeper into than just below at the surface.
Okay, thank you, Alex. I think those were very interesting perspectives. I think what Penny mentioned was ESG involves a lot of intangible assets, but from your perspective, it is more towards growth bias, and ultimately, if you can do ESG, why shouldn't you, right?
Yeah, absolutely. I think the performance argument is very much out yet to be fully clear at all. But it's pretty clear. We're seeing a lot of funds that are at least performing as good as well as non-ESG funds. So it's really, it comes down to really an argument of why wouldn't you really? But the main focus is on the positive potential impact that you can have. I think is the main argument, the most credible argument out there for why investing in ESG strategies.
All right. Thank you, Alex. So for the next question, according to a report by the CFA Institute, ESG investing is now entering the true mainstream phase. What are your comments on this statement? Is ESG investing just another bubble? Maybe I'll direct this to Nicholas.
I don't think Nicholas is there.
Yeah, I think he's having some connection issues. Maybe you wouldn't mind to give your perspective on this, Alex?
Yeah, sure. I mean, first of all, I've got to remember ESG is incredibly diverse and means many different things to different people. So I think we can all agree it's very consensual. There are certain aspects of ESG that we have the same view on. For example, having slave labor or management control systems which have had a history of allowing fraudulent practices. I mean, clearly we can all agree that is very bad. But then there's other examples on the environment, on society. There are very different opinions here. And if you look at, we've had 800 sustainable funds launched in the past 12 months. I'd urge everyone to go and have a look at what these funds actually hold, because it's incredibly diverse, incredibly different things. That's because we all have, ESG is very subjective, and we have different opinions on many of these issues. For example, in Malaysia, there's quite different views on palm oil and the positive impact that can have on employment relative to in the West. There's this slightly more negative view on palm oil in general. So when you talk about ESG, you end up with this very subjective and differing kind of range of what ESG actually means, which is why it's so hard to compare performance that ESG funds outperform, underperform, because they're incredibly different. So I think you can definitely see, at the start of this year, there were 100% bubbles in certain pockets of ESG, in clean tech, for example, which is more kind of obvious ESG, renewables. You saw these massive inflows into clean tech ETFs, and you saw some of these renewable companies go to crazy valuations for the quality of those businesses. So it's like some Ørsted trading on 65 times earnings at the start of this year, propelled really by passive flows into clean tech ETFs. So there will definitely be bubbles in certain pockets of ESG. But at the same time, at the start of this year, there are a number of healthcare companies which we actually think are really sustainable because of the positive impact they're having through their products and services. Many of them involved in making vaccines and for COVID, and also distributing these vaccines on a not-for-profit basis, which we view as very sustainable. But that's at this current point in time, it's not really seen as good ESG as much as just obvious building out renewables. So you saw really massive pocket of overvaluation in kind of that good ESG of renewables, and a lot of attractive evaluations in some of these names having a really positive impact through their drugs and treatments and their research and development. So I would say yes, you are going to see pockets of, but because ESG is so diverse and so broad in terms of what it actually means, I'd say in general. So I would say my advice would be you want to invest in a manager that's not ESG at any cost. I wouldn't go trying to really just play themes and chuck money into ETFs with no account of valuation. So you want ESG combined with valuation and quality and kind of understanding of a business.
All right. Thank you, Alex. I think Nicholas is still having some technical issues. If you don't mind, Penny, maybe you can give your opinion on this as well.
Okay. Well, for me, is I take it differently. I look at it whether it's going to enter the mainstream or not. I think ESG investment have really seen a significant growth over the past couple of years. And overall, the growth of ESG asset has actually outpaced growth of the overall market. And if you look at maybe Bloomberg's recent article in February, that mentioned that, really maybe about 1/3 of the AUM actually, you could actually hit 53 trillion in terms of assets by 2025, and maybe 1/3 of it could be the ESG global AUM. I mean, while you really see most of these flows came from institutional investors, retail investors are also getting more interested in responsible investing on the back of social media attention to the world's global challenges such as climate change, migration, and inequality, and etc. So, and it's not just millennials who are interested in responsible investing. I guess there's also a broad interest among all generations, and in particular women. And these groups want to actually know more how their money is being invested, and how this contributes to society, going beyond just pure financial value generation in that sense. So if you look at, PwC also predicts that ESG fund assets under management could actually make up of about 50% of total European mutual fund assets by 2025, which it's representing a compound annual growth of about 28.8% from 2019 to 2023. So these are the things that really telling you that people are looking into more ESG investment. Yes, could there be just another bubble of just overall ESG investment? I guess, like Alex said, it could be in different area itself and all those. But I think that also from here, apart from growing social and corporate awareness, we believe the governments will also do their part to encourage the change that they want to see, in the sense of all this. So that's why I think clearly meaningful improvement actually will be achieved over the long decades. I think there's also no escaping of critical role of that governments play, from setting the policy on climate change to sponsoring the research and development required to develop zero carbon solutions itself. So I guess this, coupled with growing public awareness, is likely to drive maybe further momentum in the growth of ESG assets itself.
I see. All right. I think what I can conclude from this is that over 800 sustainable funds have been launched in the past 12 months, as mentioned by Alex, and coupled with what Penny mentioned, that most of them are women, and it's not only targeted towards millennials who are more aware of the environment and are more environmentally conscious in terms of equality and climate change. But I would just like to ask both of you, do you think the older generation, in terms that those have been so accustomed to traditional investing, would also be inclined to invest in ESG as well? Or are we just talking about, tech savvy, social media savvy, retail investors that would invest in ESG funds? Oh, sorry, Penny, maybe you can go first.
Okay, for us, we actually also did a recent survey, maybe some interesting numbers to share. 71% of institutional investors globally plan to integrate ESG into their investment process by 2030. And 3 in 4 investors in Europe find sustainability important. And only about 14% of retail investors think that ESG investing weighs on investment performance. So from here, I guess that's something we find, that maybe really sustainable investing is, is here to stay, and it will continue to grow in that sense. So that's what I think.
I think
okay, Alex, over to you.
I think definitely at the moment we do see more interest in the younger generation. Yeah, that would definitely be fair. I think it comes back to really, I think we're still at a period of education in what ESG actually means, sustainability means. And when we think about ESG, and it's as Penny mentioned, it's also the opportunity to have a positive income and impact and support outcomes of the most pressing challenges facing the world today. And I think millennials have care about certain issues more than older generations. So, for example, I'd say millennials on average probably more worried about climate change. It's just something more relevant to them that they've kind of been brought up with. And so the older generations, probably taking COVID, for example, actually it's older generations who are more worried about COVID and more worried in general about communicable disease or general non-communicable diseases. But they're both ESG, or they're both part of
Okay, I think there seems to be something wrong with Alex's connection. Unfortunately, these are things that we face when we have online sessions. But okay, let's move on to the next question. Among various criteria that govern ESG, different companies may choose to adopt different sets of standards. I think this was addressed by both Penny and also Alex. The companies adopt different standards on benchmarking themselves as an ESG company, for example. So what are the factors that you personally as a fund manager look at when it comes to ESG stock selection? So how can investors be ensured that the ESG funds or companies that they have invested in are authentic and not merely practicing greenwashing? And I think greenwashing was something Penny also mentioned in our previous session. Perhaps, Penny, you can give some input on this.
Okay, from our side, it is actually true that different companies may choose to adopt different set of standards in benchmarking as an ESG company, because ESG is such a subjective topic. This is why having a dedicated research team that specializes in ESG, SRI research, is actually quite important. For our SRI research proprietary model that covers over 10,000 companies globally across equities, corporate bonds, and sovereigns, we actually start by identifying over 200 ESG indicators of each sector. These indicators are then weighted according to how material our analysts view each indicator is to a sector. So different sector will have different weightage in that sense. For example, an ESG issue relevance for a mining company will be very different from that of a bank. So for a bank, I mean, you will maybe focus a bit more on social governance issues, whereas for a mining, I think you pay more attention to environmental factors in that sense. So from here, we actually map up raw ESG data, where we obtain from specialized external data providers and also, and to matrices from to form our sector-specific scoring, where we range it from 0 to maybe 4. So for us, it is maybe a stock that's rated best in class will be rated like 2 or above, and while a worst in class will be anything ranked 1.24 or below, and average rated one will be maybe about 1.25 to 1.99. So that's how we adopt it in our system for our SRI, ESG fund, and all those. So I hope that answers your question.
Yes, definitely. Thank you, Penny. Hi, Nicholas, you're back.
I'm finally back. I apologize to everyone for my technical issues, but I'm here and I'm up and ready.
Don't worry about it. Okay, maybe you could weigh in on this question as well.
Absolutely. So I think rather than talking first about how we do Arabesque, I just want to talk about the issue sort of more broadly. One of the biggest challenges with sustainable investing is the subjective nature of what is sustainability. For one person, sustainability means something completely different to another person. So what's happened really over the last, actually 20 years, ever since 1997, is the emergence of standards and frameworks to help investors, corporates, and other stakeholders report on sustainability and actually really understand sustainability. So this really started back in 1997 with GRI, the Global Reporting Initiative, and this really was, trying to understand a company's impact on the environment. Since GRI, we've seen a number of new standards develop and come about. Another notable one is SASB, which came about sort of in the last 15 years, and that's more looking at the planet's impact on the company. So the notion of financial materiality, what sustainability topics are financially material for the performance of a company. And there have been another of, other initiatives, CDP, which is around, emissions, etc. The good news for investors is that these are starting to come together. So recently under the Better Alignment Project, these standards are starting to come together. So for you, the investors, for the people dialing in, the good news is that there's progress trying to bring all these standards together. At Arabesque, the ones we use, because we're always focused on sort of financial performance and using sustainability information in order to sort of enhance our information environment and make more prudent investment decisions. We are very closely aligned with SASB. So this is similar to what sort of Penny was talking about, which is the notion of financial materiality. So when you're considering sustainability, only considering sustainability topics which are material to the financial performance of a company. So for example, if you're looking at a financial services company, a topic such as diversity would be important. Whereas if you're looking sort of at an infrastructure company, then wastewater usage or something like that would be a lot more important than something like diversity. So that's the way we do it in Arabesque. We do diverge slightly from SASB. So we do have a dynamic aspect because SASB is pretty static. So we actually sort of do a three-factor regression, farm preferential regression, and try and explain the residual, so basically unexplained alpha, using sustainability topics. So this is how we kind of slightly diverge from SASB, but largely it's a very similar approach to the one that Penny was laying out.
All right, thanks, Nicholas. Similar to what Penny was saying, do you have like a scale rating in terms of how you rank certain stocks or companies based on their financial materiality, as you've mentioned?
Yes, absolutely. So Arabesque, which is the company I represent, is actually three companies. We're an asset manager, which is where I sit, but we're also a data company and an artificial intelligence research and advisory company. So in the data part of the business, called Arabesque S-Ray, we do have our proprietary in-house scoring mechanism, which is, rates companies a number of sustainability topics, not just ESG. We have, scores to see whether companies are Paris aligned. We have scores to see whether companies are aligned with the United Nations Global Compact. We have loads of other scores. And these, rank companies on a scale from 0 to 100. And then that's the data that we then leverage within the investment process of our strategies. Yes, absolutely. We do have our own scoring mechanism. And it's not just used by us, it's used by some of the biggest asset owners and asset managers in the world. So some notable clients are Citi, GPIF, AP1, some of the people who use our data.
All right, thank you, Nicholas. Moving on to the next question. Do you think that ESG disclosure reports should be mandatory for companies to include in their annual financial report, even though it is not enforced by their state law? So I think this is something that Penny and Alex mentioned earlier, that ESG is quite dependent on government enforcement, for example, because it can be quite expensive, right? So in terms of ESG funds or companies and reporting, how do you think this will help fund managers to make better decisions if this annual report were to be mandatory by each state or country? Sorry, I'm gonna direct this question to you, Nicholas.
Oh, great, thank you. So I would take a bit of a nuanced approach to this. There's huge value in disclosing on sustainability. Sustainability issues are obviously extremely important for investment decisions. They do impact financial returns. There's a number of, case studies on this, looking at companies who were performing very badly on sustainability and then later ran into a corporate scandal and led to a lot of money being wiped off sort of market value. So, these are financially material issues which investors need to know about. But although that's kind of the benefit of reporting the downside is that it comes at a huge burden, what's sometimes dubbed in the industry as a reporting burden. So I would probably take a kind of a similar approach to how the EU has approached this with their latest sets of regulations on sustainability, which basically disclose any companies with more than 500 employees to report on non-financial factors. So I would probably, urge for that sort of approach, which doesn't penalize, your tiny little company of 10 employees, which they're going to, struggle to put together a sustainability report. But it does give investors sufficient information when they're looking at a company of that size.
All right, thank you, Nicholas. Alex, could you weigh in on this as well?
Sure. I think to some degree, certain requirements are absolutely necessary. But one issue you do have is, well, first of all, who so what should be.
Sorry, Alex, I think your line is not so clear.
Sorry, I think we're all struggling a bit with this StreamYard.
Yeah, a little bit.
But, so, for example, the EU taxonomy that's recently come out. So this is talking about the revenues or the investments that a company's made. Sorry, I'm not sure what's going on here with this with StreamYard. So you have the EU are sustainable. So, and coincidentally, if you produce vehicles which are below 50 invest in, you're producing vehicles that are below 50 grams of emissions, that's seen as an entirely sustainable activity, which then ends up, VW and Daimler, for example, then get fantastic scores. So you can clearly see there's, a really decent chunk of kind of lobbying influence, on that. So it really comes back to who should dictate, what is sustainable activity. And while certain activities and reporting on emissions, it's very clear. This is very clear. On the other side, you've got into a point with these companies where you can read a 200-page CSR report for a company, and it doesn't really get to what is the actual impact this company is having. What is the main impact of this company as a result of its existence? And when I say that, I probably differ from the other panelists. I'm talking about both financial materiality, but also what is the impact of this company from a non-monetary perspective on other stakeholders? So, for example, if you're looking at a company which is has mobile payment business, which supports financial inclusion in Africa, really what you actually want to understand is the impact that had on human life because of a result of their mobile payments technology being rolled out. How many people now have access to banking services that otherwise wouldn't have it, and what was the impact on their life? That's really what matters. Similarly, if you're looking at pharmaceutical companies, and particularly, for example, these companies involved in making COVID vaccines or other treatments for HIV, really stand. It really varies massively depending on the company and can be quite idiosyncratic when it comes to social factors. So I think there's a balance to be struck. I think we can all agree on perhaps the more quantitative ones, but at the end of the day, ESG is subjective and can be very idiosyncratic. So I think it does really vary, and I would say we need to be careful not to overburden.
All right. Thank you, Alex. I think what we can conclude from this is that there should be we should be reporting the correct things. Not just a simple reporting with all the quantitative figures, but also what is the impact of this company's existence to people in general or the environment, you know. And also, I think it's also important to not overburden companies, like both you, Alex, and Nicholas mentioned, on reports after reports, because currently a lot of people do CSR reporting, but as you mentioned, we don't really see what is the impact of their company towards human life. Okay, so maybe we can move on to the next question. In a situation where there's a trade-off between companies with strong fundamentals and a low ESG rating versus companies with weaker fundamentals but have a high ESG rating, which would you prefer? Also, what is the relationship between ESG ratings and the long-term performance of a company? Maybe I'll direct this to Nicholas.
Thank you. So I think you have to remember that sustainable investing is a huge field, and there's going to be lots of different types of funds within, the ESG or sustainable investment field. So, if I, take a look at our company and the funds that we have lots of different funds, and they have different investment objectives, and there's trade-off between how you consider ESG information and fundamental information, as well as lots of different types of other information we use. Really depends upon the investment objective of the fund you're looking at. So with some of our funds, which just target, sort of capital appreciation with no sustainability objectives. So, what some would probably consider sort of an Article 8 fund under SFDR, the EU's regulations. The trade-off would probably be more towards, favoring the financial information, the fundamental information, because, it's not really concerned too much with targeting an environmental outcome or a social outcome. It's really concerned with targeting a financial outcome. So although we consider sustainability information, the weightage will be more towards the classic drivers of expected return. With other funds, for example, we have a climate fund. Here, the weight will probably be more on the sort of environmental data, so the E spectrum of the ESG, because the fund is concerned with, targeting environmental leaders as well as driving a financial return. So this trade-off really depends upon what you're trying to achieve as an investment vehicle, as an investment strategy. And where, some of our funds, the weightage would be way towards the fundamental and technical information, and not so much on the ESG information, but with other funds, it would be sort of the other way around. So that's probably how I would answer the question. And just quickly on the second part of the question, the relationship between ESG and financial performance, there is a strong relationship. And this is the reason why so many in the industry are doing this. It's expected by 2025, $1 in $3 globally, $1 of AUM will be invested through an ESG lens. So that really shows you that, it works. And there is this relationship between financial performance, risk, return, and ESG performance. That's why so many are doing it. There's been a lot of research on the matter. We produced a meta study back in 2015 now with Oxford University, which cited more than 200 studies and found in 90% of the studies that we looked at, 90% of those 200, there was a strong relationship between stock price return and ESG performance. So I think, a lot of research like this, other great studies have come out by other banks, and this has really helped the industry realize that there is a relationship is there, and it's worth considering within investment decisions.
All right, thank you, Nicholas. Penny, would you like to tell us your opinion on this as well?
Sure. I agree with Nicholas, and it's very much in line with what I want to answer. My answer to you. We actually integrate ESG factors throughout our entire investment value chain to better manage risk and generate sustainable long-term returns. And 100% of assets are risk aware, meaning to say we consider sustainability issues in our investment decisions and engagement. But of course, like Nicholas said, different investors may have different requirements when they invest in the fund. So which is why we provide sustainable investing processes with a broad range of approaches adaptable to different levels of ESG incorporation and client preferences in that sense. So example for an integrated ESG fund, okay, the investment universe is not constrained. If a company has very strong fundamentals but poor ESG rating, investment team may occasionally still invest in those company, but provided that the portfolio manager has properly accounted for the ESG risk and are actively engaging with the engagement of the company to actually improve their ESG rating. But For SRI best-in-class kind of strategy, as best-in-class already suggests, ESG quality will be a focus and it will have to exclude those poorly rated companies. Now, having said that, usually negative ESG events do seem to, in a way, predict a degree of underperformance, okay? Not 100%, we do in a way, but so far we have been able to demonstrate that ESG research can be an important indicator of future performance in a way. Where possible, we tend to avoid companies with ESG red flags. Now, as also Nicholas mentioned, many academics have actually studies now have showed a positive correlation between good ESG risk management and also financial performance. Now, in AGI, we have synthesized this into a white paper called ESG in Equities, where the white paper uses recent publicly available studies written by academics and financial service providers to analyze the financial materiality of environmental, social, and governance factors for listed equity as an asset class itself. So it is interesting to note that one of the findings was many of the newer research studies showed that superior ESG strength in an equity portfolio appear to lower volatility risk relative to a portfolio of firms with lower ESG scores. So in other words, better ESG rated corporates seem to surprise markets less often in that sense. So yeah.
All right, thank you, Penny. I think what we can conclude is that ESG is generally a spectrum, and many investors have different requirements. And I think what Penny mentioned was that there are different degrees of ESG involvement, in different funds as well. And I think what's important is that it depends on what the client's end objective is. Is it merely to invest in a pure ESG fund, or maybe they want some ESG factors included in normal investment strategies, for example.
Can I just add a point here? I think just taking one step back as well, I'd urge people to look at a number of reports on the correlation between, I'm talking about just talking about external ESG ratings. I mean, you can literally plot ESG rating of MSCI versus Sustainalytics, and you end up with a zero correlation scatter graph, because ESG is so subjective, and so even these kind of external ESG rating agencies, they end up with massively different kind of opinions and outcomes of what the scores are. So I think that's got to bear that in mind. And then again, it also matters on the spectrum of what you're trying to achieve. Look, ultimately, none of us here have a mandate to deliver underperformance, and given the responsibility of managing clients' money and use it kind of for charitable purposes to have a more positive impact. First and foremost is always performance. Like I said, the question is quite interesting from a philosophical perspective in really pushing the boundaries. Look, I mean, ESG does not always go hand in hand with financial returns. And I've said this a few times now, but it's way too simplistic and one-dimensional as an argument. And then you get back to the point of, well, if ESG didn't outperform, for example, if this relies on whether it's been priced in, has the ESG been priced in? It's not just, is the company good or bad on ESG, but has it been priced in? There's that argument as well. But that's what makes it whether it's going to outperform or not just whether it's good on ESG or bad on ESG. So you get to the stage of, well, if ESG was shown not to outperform because it had been overly priced in by the market, would you do it anyway? I think that's a really interesting question. But then again, there's grades and there's limits. I think we could all agree, for example, if there was a company that, for whatever reason, because it wasn't very well regulated, didn't have very strong government, or but it involved in slave labor, but it was clearly going to make very strong returns. I think then that comes to, there's also kind of there is an ethical angle to it as well. That's something which personally, I wouldn't ever invest in that company if I knew it was having this incredibly negative impact, even if I thought it was, even if I thought it was going to, have really strong returns. So I think to us, as an industry, we need to break this argument of, just focusing, on returns. I think it's far too one-dimensional. But yeah, so again, but it's very graded. It's very subjective, and it's really graded. But I think we really need to have a more nuanced kind of approach to thinking about this as an industry.
I think that was a very good perspective, because I think we're moving towards an era where it's more than just returns now. What we're looking at, what is the right thing to do? What kind of companies do we want to support as investors, or even as institutions? With that, I think I'd like to move on to the next question. It has been observed that the net inflow of funds into ESG investing has accelerated drastically since the COVID-19 pandemic outbreak. Do you agree that COVID-19 has become a catalyst in expediting this trend? So in your opinion, what are the impacts of this pandemic on ESG investing? Alex, would you like to give your opinion?
Sure. I think it was partly coincidental. If you look at ESG flows and ESG fund launches, it was on this uptick, and then it sort of accelerated. I think it's a number of things. One was that a lot did and so I'm not sure where I cut out there, but a lot of ESG funds performed really well in the downturn. A huge amount of that can just be attributed to really big quality bias and a really big growth bias, which obviously outperformed in a downturn, and then had a really positive benefit from interest rates collapsing. It's fantastic for growth stocks, where a lot of the value is in very far in the future. But of course, it also had a really big impact on us thinking about our own personal impact and the impact of our capital, and really this kind of collective thinking of actually when we work together, and a changing of some views on industries. The pharmaceutical industry was by far the most hated industry within the US. This industry, because of its investment firepower, its R&D capabilities, they came up with vaccines in record time, and some of them are doing this all on a completely not-for-profit basis. I think that's definitely changed the views as well. But it also shows how things are interlinked with different stakeholders, because you've also seen governments come out and say, we're going to build back better, we're going to really focus on doing certain things, such as building up more renewables, retrofitting buildings at a much greater rate to reduce their emissions. So a lot of the money has also followed that as well. Investors trying to pick one, shouting very loudly, they're going to introduce changes and fiscal support for certain things, then investors also end up following that as well. So I think it would be too crude to say that we've all had a spiritual enlightenment from the COVID pandemic, and I'd say that's definitely part of it. But it's a lot of different things that have all really come together to support this. And now we're actually in a really quite fragile place for the industry now, in which we need to now prove ourselves, and also make sure that this trend continues. So we need to deliver for investors who are interested in this, and really prove to them that this is the right direction for things to go.
All right, thank you, Alex. Penny, maybe you'd like to weigh in on this?
Okay. I think the past year has been maybe an inflection point for sustainable investing itself. Why? Because in previous years, the focus for asset managers was often on proving the performance of sustainable strategies and all. But within the passing of 2020, massive flows were into strategies. The massive flows into these strategies actually they speak for themselves. People have been more convinced of the necessity and value of investing sustainably. This represents also maybe a fundamental shift in mindset. Even as COVID-19 pandemic, rolled the markets and upended ways of working and living, investors allocated more to sustainable investing strategy itself. So I guess For me, it's I think really indeed rather than distracting attention from sustainability, the pandemic maybe in a way has highlighted real world issues that only sustainable investment can help, solve in that sense. So I think after this, everybody is looking into how we live and work differently right now, and sustainable, and how do we continue this and all. And moreover, you look at the European Green Deal means that EU will push for to become climate neutral by 2050. China has pledged to reach peak carbon by 2030, and also the way of its goal of carbon neutrality by 2060. So clearly, I think meaningful improvements will be achieved over the coming decades. And like just Alex say, many have heard the global rallying cry to build back better following the pandemic, and that requires us to maybe think sustainability in that sense. So that's my answer for you, Azanne.
All right, thank you, Penny. Okay, following to the next question. What is your opinion on the role of technology when it comes to ESG investing? So I'm going to direct this question to Nicholas.
Thank you. So right at the start of the inception of our company, actually pre-being independent and when we were part of Barclays Bank, our founder, Omar, wanted to create an asset manager that was completely sustainable. So he was working closely with universities, researchers, etc. And what we quickly realized is that in order to really have a sustainable investment approach, you need to have a heavy emphasis on technology. If you think about the nature of sustainability, it's unstructured, it's messy, it's constantly updating, it's updating daily, it's dynamic. In order to process this at scale, you need to leverage tech. You need to make sense out of this big data. So ever since inception, we've always had a huge emphasis on technology. We use artificial intelligence to pick up dynamic relationships. We use other algorithms to structure big data and combine it into an easy to read format. So at Arabesque, we've always placed a huge emphasis on technology, and we believe this is the most scalable approach going forward. If you want to update your sustainability scores daily and take into consideration the latest news articles or controversies, there's no other solution than leveraging tech in order to do that at scale. Once again, if you want to, enlarge your investment universe to cover thousands of companies, which is constantly updating, taking in the latest information, once again, in order to do this in a scalable approach, you need to leverage technology. So we've always placed a big emphasis on technology broadly, but it was a result of how we wanted to integrate sustainability into our sort of asset management service.
Thank you, Nicholas. Penny, could you give us your opinion on this as well?
I guess I agree to Nicholas in that sense. Information is now very, very important, and a lot of information we get is through technology, and you see that some people use a quant model before they move on to their, the fund manager will look at it anyway. So I guess data is sometimes now called the new oil, given its integral role in functioning the world's economy. But of course, I will look at it in the point of how secure are those data and all. So in order to, cybersecurity and all those are important, because all this to make sure that the data gives a very accurate ESG kind of risk ratings and all those, and all these things. So that's why I would think that data technology do play a part, and it's getting more and more important. We are in a technological kind of world, and with this pandemic, like the digitalization has come really, really fast. So I guess it is important I would think that it is important for ESG investing as more and more data, and we need those kind of set of data to make maybe a more informed decision in that sense. So yep, that's what I have for you, Azanne.
All right, thank you, Penny. Okay, so this is our last question for this session. What are the potential challenges or risks that could be faced by investors when they invest in ESG funds or other ESG-related investments? I think this is a question that we get from a lot of our B2B partners and also our clients. Apart from knowing what ESG is, they would also want to know, what are the risks involved? And maybe I'll direct this question to Nicholas.
Thank you. So I think the elephant in the room here is really greenwashing, and this comes from the supply of ESG funds. A lot of people are realizing that this is an incredible marketing opportunity and are, saying they're doing more than what they're actually doing. So I think although this has been a big challenge, so for you sort of investor, investing into a product that you believe is sustainable and is going to make a big impact on, the environment or social norms, but it's actually not doing what it really is measuring up to. That's been the challenge. But the good news for that is there's been a number of developments in the industry, mainly regulations, to really help investors really understand the products they're investing into and make sure they are doing what they're saying they're doing. So one has been SFDR. So this is basically labeling funds based on how they integrate sustainability and also the objectives of the vehicle. So an Article 6 fund will not integrate sustainability or ESG considerations. An Article 8 fund will integrate ESG considerations, but not have a sustainability outcome. So a bit like, what I was referring to before, where you're sort of using ESG more as a risk manager and not actually caring too much about the environmental social impact. And then you have Article 9, which is sort of like the gold standard of ESG funds, which is where you have an environmental or social outcome as part of your investment objective and also consider governance. So I think these, and although they've been in the EU, I imagine that other regulators and central banks and et cetera are going to follow suit. So I know in Singapore, MAS are looking at developing a taxonomy. Bank Negara in Malaysia are doing something similar. So, I think these standards are going to really help investors to make sure that they can really overcome greenwashing, because it is a big problem. It's the number one issue we have to really tackle in order to really mainstream sustainable investing and make sure that the consumer is really, getting value for money or investing in what they really want to be investing into.
Thank you, Nicholas. Alex, do you have an opinion on this?
Yeah, sure. I think it's very difficult for investors, as I mentioned before. Kind of 800 funds, sustainable funds launched just in the last year. I think you've got to be asking yourselves questions, particularly particularly when you've got funds which have now they've been XX income fund for 10 years, and now as of 1 year ago they're now the XX sustainable income fund. I'd be very cautious about funds which have relabeled themselves and now suddenly are sustainable funds. I'd also say you just got to cut. I think the industry's got to do a better job at helping you to cut through all the noise. It's very easy for people to come market to you and tell you how many people they've got who do sustainability and how great they are, but really you want to cut through the noise and you want to understand, well, what is the impact of the underlying holdings and what is the impact of the manager? So what we do is we report kind of an underlying impact of the fund per $1 million invested, and that I really think this is going to turn into the second axis of performance. So you're going to look for investors going to look for investment performance and then impact performance, so of the underlying holdings. So and they might see if they might look at my fund and say, well, look, actually this fund has a lower impact on the climate, but on climate change, mitigating climate change, but more impact on mitigating the obesity epidemic, more impact on eliminating communicable disease, and actually that's more aligned with my views versus another fund which is maybe even higher climate impact, but not as focused on social issues. So I think you really need to that really help. I think that's the most simple thing I've seen, and that really helps the conversations that I have most. Really be able to say, look, per $1 million invested, that's 400 tons of carbon saved. That's 300 people reached with vaccines. That's 66 people now having access to mobile payment services. I think that really helps to cut through the noise of the industry. And also, what is the impact that you're having as a manager? I think this is becoming more and more important. So with the impact of your underlying holdings, and you've got, well, what did you actually achieve as a manager? What did you actually, what do you care about? I would ask fund managers, what's your philosophy? What do you actually care about? What does ESG mean to you? I'd also demand transparency as well. So we report every single holding that we have in the fund, and we report every single metric we're tracking for that. They're really kind of, by impact metrics, I mean really drilling down to what are the main impacts that a company is having as a result of its existence. So if it's a company like Gilead, how many people is it reaching with its HIV treatment in lower middle income countries through its access strategies? That really shows you what the real kind of main impact is of that company as a result of its existence. And that's what you really care about, to be honest, rather than being told there's a 20-person responsible investment team and they're all fantastic. That doesn't really mean anything, to be completely honest. And you have a big issue as well from that perspective of, I'll just give you an insight from my conversations with senior management. You have responsible investment teams which are giving investor relation teams at companies a really hard time about ESG matters. The CEOs of these big companies are then being prepared for all these ESG questions when they meet the portfolio managers who manage very big funds, and the portfolio managers are asking them absolutely no ESG questions, and the CEOs are just saying it's really denting the credibility really of the responsible investment industry. So I'd be very cautious in just taking asset managers' word of how big their responsible investment teams are and all of this kind of stuff about what they're actually doing, and actually really focusing in on saying, well, tell me what the impact was of the strategies of the strategy that you want me to invest in. Tell me how it's aligned with my views, and tell me what you're doing and what you actually care about in terms of the issues that you are trying to have a positive impact on. I say one thing that we really care about is eliminate communicable disease and the COVID pandemic. So we're doing a huge amount of engagement at the moment with pharmaceutical companies that are either making treatments for COVID or sorting out access to medical oxygen for COVID in Africa. So what we're doing is we're trying to engage as much as possible with these pharmaceutical companies, hold them to account when their pricing of these treatments isn't fair and equitable. And I'm happy to share offline kind of some of the results we achieved because of that. But so you really need to try and cut through the noise and really demand transparency from. I think that's accountability and transparency are incredibly important nowadays, and I wouldn't accept anything less than full transparency. If someone wants to take your capital to invest it in line with your beliefs and your desires to have a more positive impact or a less negative impact.
All right. Thank you, Alex. We actually have some questions from the floor. Okay. The first question, I'd like to direct this to Penny. What do you think about investing in China, especially since human rights standards are quite questionable in China, as some of our viewers have asked? How does that work on the S part of ESG?
Well, I think as some of the companies that we invest in, as I said, we are aware of that issues. Is whether you want to take that on. I guess those with really controversial ads and all those, definitely, I think that would not be something that we would like to invest in. So that's why I think all this information, it's very important for us to make an informed decision on all those companies. As I said, some of our strategies are integrated ESG, and of course it may not be in, I'm not sure, but it could be it won't be in the very like the best in class kind of companies, strategies that we have, due to the fact that some of the information is not very clear cut, as in we don't get a lot of information from those companies in that sense. But I guess not all companies are bad, I would say. If you look at it, there are also other companies in other parts of the world that could be, So I guess we really have to look into how we want to manage that in terms of whether that company will fall into some of our really, best in class, SRI kind of companies, or those are just integrated. But we are definitely aware of all those before we make any decision investing in those.
All right, thank you, Penny. The next question is directed to Alex. Some of our viewers have asked, so there are some countries now that are trying to make vaccination compulsory. And as you mentioned, ESG is very subjective, right? It depends on what you believe in. It depends on what, people think is important to them. How will this impact, investing in that particular country in terms of ESG?
Yeah, that's a very tough question, and probably limited in what I can say from a company perspective on any kind of views on vaccines. But I would just say this is ultimately, again, ESG is quite subjective, and if we're investing your capital on your behalf, we should be doing it aligned with your views to the greatest extent we can. Obviously, we have many clients. I would say just it's got to take into account, people's, investors' opinions on that. And if investors have a certain opinion on a matter, then that should be to the greatest extent reflected in an investment strategy. Because ultimately all the investment manager industry is ultimately just a vessel to really reflect what society wants, and that's how it should be, and that's more and more what it is becoming. But yes, it's a bit different to talk, specifically on vaccines. I'll probably be in trouble with my company.
All right, no worries. Thank you. I think you've answered that question already. So moving on to our next question from the floor, I'm going to direct this to Nicholas. What are your thoughts on ESG bonds?
Yes, I was just about to say, I think that's probably best directed to one of the other panelists. Arabesque is a pure play just focusing on ESG, equity, quantitative investing. So we don't actually have any ESG bond funds, and my knowledge is limited. So I'd love to direct it to one of the other panelists who'd probably be better suited to answer this question.
I mean, I run an equity fund that I would say I think they can work fantastically hand in hand. And I think the ESG in the bond space, I've been quite frustrated for a long time at how it's been seen as not so important. But actually, public equities, we are ultimately, in theory, we are the owners of these businesses, and we can vote. And I would say probably management teams are more willing to speak to equity owners than bondholders. But on the flip side, most of the time we're dealing with secondary capital, trading secondary capital. With bond investors, companies are having to come back to you again and again for primary capital to refinance. So you have almost a different lever with which you can sort of apply pressure from an ESG perspective to these companies. I mean, it's not as simple as this, but very bluntly, if you do not, as kind of people who could potentially be bondholders of primary capital, if you do not do this, then we are not going to offer you capital, or we are going to demand a much higher rate of return. So there is different nuances. And so what we've been doing more and more is we've been working more. We have a very large subsidiary with fixed income house, working more with them and saying, look, you can apply a certain pressure. We can apply a certain pressure to companies from a different kind of perspective. And I think that's just really shows, where we're moving to as an industry, as society, working together, different perspectives, different angles within which you can attack this. And so I'm rambling on now away from the question, but you're also seeing more and more. So we're now working more and more with fixed income investors and trying to, we ultimately want the same outcomes. We're also working more with governments. We're also working more with NGOs, ultimately with this goal of trying to support better outcomes, better companies. So I think a lot of these stakeholders actually have a much more important role to play than has been previously perceived. I'd say I would go as far to say as actually society and everyone on this call today is probably, doesn't on average doesn't have the kind of the perception of the importance that they play and the impact they can have in expressing their views, voting with their feet on what funds they invest in, but also just generally putting pressure on fund managers. So sorry I've waffled on there, but I really think this question leads into the broader kind of position we're in at the moment, in which there's a lot of different stakeholders coming together and using the asset management industry, as sort of a vessel through which to, try and support better outcomes is a massive trend at the moment.
All right, thank you, Alex. Okay, so I think that concludes the end of our session. I think what we can conclude from this is that ESG is very diverse, and there are benefits, but also some of the risks include greenwashing, and I think that's why it's very important for all investors to be able to study into the funds that they invest in and the companies before actually investing in them. And I think all three of our panelists come from very prestigious companies who do the due diligence in terms of, selecting what companies that they invest in before putting it into the fund. So I'm going to hand this over to our host, Esty.
Thank you, Azanne, and also thank you to our fellow panelist and moderator, Azanne. We have come to the end of our session today. So thank you everyone for joining us. Before you go, do remember to like our Facebook page for more updates and also share this webinar with your friends. And on behalf of Phillip Capital, thank you for joining us and have a great rest of your day.
Thank you, everyone.
Thank you.
Thank you.